your portfolio. Always consult with a qualified investment, legal, or tax professional before taking any action.
You've worked hard and saved for retirement, but remember, it's what you do with that money that really matters. How will you ensure that you wring every nickel out of your Social Security benefits? Could you pay fewer taxes in retirement? And how and when will you withdraw money from your IRA or 401k? Welcome to Secured Retirement Radio with Joe Lucy of Secured Retirement Financial. Joe's a certified financial planner, fiduciary, and a contributor to the Wall Street Journal, and has nearly 25 years of helping people just like you. This is where you can count on straightforward and objective advice on how to make your money go further in retirement. And now, here's your host, Joe Lucy.
Maybe you've noticed, but things are getting just a little bit more expensive lately. It's not an illusion. For the first time in a long time, inflation is a very real threat to everybody, especially those of us getting ready for retirement. Now, according to one report, the U.S. is on the verge of one of the worst bouts of inflation in decades. Now, this can spell disaster if you are somebody that's in or nearing retirement. So welcome to Secure Retirement Radio. I'm Joe Lucy, certified financial planner. I got Nate Zeller. He's our chartered financial analyst. He's also a CFP, and it's going to be the two of us. We got Dylan taking some time off for the holidays this weekend. So anyways, inflation is back, and it's heating up faster than most of the economists had predicted. In fact, October's 6.2% inflation rate was the highest jump in over 30 years. But it's not the most alarming news. This trend has been accelerated. Economists, world experts on inflation, Peter Schiff said, you have to look at it like an inflation tax. In fact, it's a regressionary tax. It's taxing those with less more, because we're all paying this. Higher prices at the gas pump, higher prices for this week's turkey, higher prices to heat our homes. Now, I imagine, or I like government proposed tax hikes that are just for those higher earners. This tax is going to hit everybody. And the economic impact, well, it could be worse than the recent pandemic. So coming up on today's show, let's talk about inflation crisis in America today, what it means for you and your retirement, plus how to position and protect your investments and your retirement against the impact of inflation.
Good morning, Joe.
Morning. How are you?
Real good. Real good.
Good to see you, Nate.
Thanks for having me.
How was Thanksgiving?
That was great. Great. A little more expensive than years past, though. I mean, that was somewhat noticeable. I was surprised at the cost, out shopping, finding a turkey and everything, and it was, not too terrible, but, more than what I planned on spending or expected anyhow, so it was some sticker shock.
Well, Ronald Reagan called inflation the silent killer. It seems to creep up on us, and before you know it, everything is more expensive. It means the dollars you have are buying less, which is really... if you're not preparing for this, you could be going backwards with your retirement savings.
Yeah, I mean, the thing to think about, too, is this is a big erosion in purchasing power. So let's back up, and kind of give a quick definition of inflation and what it is. It's obviously higher prices. What's caused it is we go back to the pandemic. There was a lot of, people staying at home, not spending money. Everybody was worried. They didn't know what was going on with the economy. The economy was shut down. Were they going to have jobs? Were their wages going to, keep up? And so people stopped spending. Then now, the pandemic's still here to a certain extent, but people return to their normal lives, and there's this pent-up demand. So people are out spending money. There's all the stimulus checks. The stock market's done well. People have more money in their savings than they're used to, so they're out there trying to spend all this money. And, the traditional definition of inflation is too many dollars chasing too few goods. And that's what we're seeing now is there's a lot of dollars and there aren't as many goods. The pandemic also caused some real constraints, supply chain bottlenecks that we've heard so much about. There was, factories shut down for a while. We hear about microchips not being manufactured, and those go into about everything. So it's really it's a double whammy here. It's coming at us from both ends. Too many dollars, not enough goods, and it's leading to much higher prices.
Well, yeah, the higher prices, 6.2%. That's the official CPI numbers that came out here just in October. And, this rising inflation, what it does is it puts retirees at a major disadvantage because we're already being hit with other rising expenses, things like healthcare, long-term care. But inflation starts taking away from this purchasing power even more when you start adding additional costs, gas, groceries, etc. And what that really does is if you're in retirement and you don't have a plan around inflation, well, you could end up struggling to afford some of those things you need. And this is really kind of important because, boy, since, 1990, we really haven't even had to think about inflation. Look at your cost of living adjustments to your federal pensions and your Social Security. We're talking less than 2% for the most part. In fact, many years there were no cost of living adjustments. And here, the Social Security Administration has just recently announced almost a 6% increase next year, 5.9. The government recognizes that the cost of things are much higher. You already know this. You're going to the gas pump, and what was costing you $50 is $75 to fill a tank. And when we start looking at all the other expenses out there, unlike an earner, somebody that's in the workforce, their salaries, their income may adjust up. But for the average retiree that's already set aside money, you put aside this money and now you got to take it back. How do we really start to address this in our retirement planning? And it has to be more than just focusing on the investments. Whether I should be buying more growth or small caps, It's about how to put together an income plan, documenting that plan, knowing that it's fully stress tested. It's going to be there regardless of what occurs. How do I take my money back? How do I make it last a lifetime? How do I, if I can, reduce my taxes so that I can have that secure retirement that we're all looking for?
Yeah, and Joe, you hit on another point here, too, is taxes. So, especially for retirees, they're getting hit with inflation, with higher prices, and then they also need to worry about taxes. Most people are taking their money out of qualified plans and having to pay taxes on that, so that it's very important they have a tax plan in place in conjunction with the income plan that you're talking about.
And, the current administration has promised us higher taxes, and quite frankly, even if they weren't making that promise, we'd have to see them. We've had trillions and trillions and trillions of dollars of additional stimulus. Yeah, Donald Trump passed $1.5 trillion. Joe Biden came in, passed another one right away. Now we've got the infrastructure plan at a little bit better than $1 trillion. There's the Build Back Better America plan that's being proposed that was signed by the House. It hasn't been signed by the Senate yet. We're talking anywhere from another 3 to I've seen numbers as high as $6 trillion when you start to add it all in. This is just going to continue to fuel this inflation fire, isn't it, Nate?
It is. Getting back, it is a lot of money. It's out there. I mean, more money in everybody's pockets. The money supply is much greater, and inflation is going to continue. We've seen that this year, too, as inflation has slowly been rising, and it's actually started to accelerate over the last few months.
I don't know if this is going to be transitory, but, you have to understand that growing your retirement savings, it is even more challenging today than ever before. Now, you may not realize it, but probably the fastest, maybe even the safest way that you can grow your nest egg right now, well, it's by focusing on exactly what you were talking about, Nate. It's about reducing your taxes in retirement. After all, the less you have to pay to Uncle Sam, well, the more money that you get to spend on you and your family. That's why we're making a special offer this morning just for this weekend's Thanksgiving listeners of today's show. You learn how you can reduce, even eliminate taxes in your retirement with a free secured retirement tax analysis. Now, here's how it works. When we get some basic information from you, we will determine some tax saving strategies that are best suited and tailored to your specific situation. We then can sit down, we'll share these strategies with you, and you can see exactly how much money you could be saving with some savvy, smart tax saving strategies. Now, this isn't about some simple deductions that might return or reduce your taxes in just this tax year. We're talking about tens of thousands, maybe hundreds of thousands of lifetime savings in taxes. The opportunity to take advantage of some of these strategies could be closing very soon. We know that tax rates are going to have to go higher. So if you give us a call this morning at Secured Retirement Radio and ask for your Secured Retirement Tax Analysis, we'll make sure we find a qualified advisor to sit down with you. The number is 952-777-8838. That's 952-777-8838. Request your Secured Retirement Tax Analysis this morning by calling 952-777-8838.
Consumer prices nearly quadrupled during the 70s and 80s inflation era. Could we see this happen again? We'll share the answer when we come back.
He's Nate Zeller. I'm Joe Lucy. We'll be back with more Secure Retirement Radio after this short break.
He's a certified financial planner, fiduciary, and a contributor to the Wall Street Journal. And he's no ordinary Joe. You're listening to Joe Lucy on Secured Retirement Radio. One of the biggest tax increases in decades is coming. Soon, you could be paying higher federal income taxes, higher capital gains taxes, higher taxes on your IRA and 401k, higher estate taxes, and more. But if you take advantage of some simple tax planning strategies now, you could save yourself a
Some economists believe that we could be on the verge of the worst bout of inflation that we have seen in decades. Well, some economists, I think most of us out there looking at the gas pump and our bills at the grocery store, we already recognize this. Now, economist and inflation expert Peter Schiff called it an inflation tax. And unlike the proposed tax hikes from Washington that are supposed to only hit those high income earners, this tax, well, it's going to hit everyone. And its economic impact, well, could be even worse than the pandemic we've gone through. So, welcome back to Secured Retirement Radio. I am Joe Lucy, certified financial planner. I got our chief investment strategist, Nate Zeller, with me this morning. And today we are talking about this inflation crisis that we are all living through right now in America and how this could impact your retirement future. Coming up in this segment, question that we might want to ask, are we heading back to the 1970s or the 80s style version of hyperinflation? Well, we better hope not, because the impact of this could be devastating to many retirees.
So, Joe, if we look back 30 or 40 years, I think a lot of the listeners here at Secured Retirement Radio maybe don't remember it, or they're much younger, and it probably affected their parents more than them. But back in the 70s, we had what was called stagflation. So that's high levels of inflation with very low or maybe moderate economic growth. Also, there was high unemployment at the time, and that was a very difficult time for investors. There was negative real returns in the stock market. And a real return is you take your return, you subtract out the effects of inflation, and they're losing money, or at least they're flat for a whole decade. And so I think most of our investors today aren't quite used to that. They're used to high stock market returns and very low inflation.
Well, and let's hope that we aren't heading back to the days of these long gas lines and what have you. When I was probably about 8 years old, I remember my mom and we would go to get gas. I mean, this was not like just running up to the store for a gallon of milk. This would take hours. You would have to wait in the line. I remember one time I was, like I said, about 8 years old. I remember pushing my mom's car because she had run out of fuel. We all remember, or many of us remember those days, but we didn't have to necessarily, all of us have to live through them, because like you said, Nate, many of us were maybe still, in high school or not where we are today. The last time the U.S. economy saw such sustained inflation was back to the 60s and 70s, and it devastated investors and especially devastated retirees living on fixed income. This data we've been talking about this morning from the Yale finance professor and Nobel laureate Robert Shiller, he tells a grim tale. By the time of the Kennedy assassination in 1963 until the middle of the Ronald Reagan first term in 1982, the total return on U.S. stocks when measured in inflation-adjusted terms was zero, slightly less. Investors who had been expecting that average of 6 to 7% return, or maybe you've even experienced a little bit better returns than that lately, ended up with bumpkins. I mean, they ended up with nothing. And worst of all, they lost 20 years of wealth accumulation that they never ever able to get back. Nate, you manage a lot of our portfolios here, and as at Secure Retirement Radio, we are often hired because, number one, the task that we're always assigned is to make sure that we can help families create an income plan so they can spend in confidence. Number two is to help reduce taxes, and the third is to grow wealth. But Nate, as you're managing our portfolios, what are some of the things that you are bringing into the portfolio? What are some of the things you might be avoiding in case this transitory, is what the word has been, inflation turns it to be something that could be lasting a little bit longer?
Yeah, and it looks like inflation is going to last a little bit longer. And it's funny that word transitory now they switched to persistent, but that's just kind of a side note here, and it makes me chuckle a little bit that the Fed is changing their stance. The things that we're looking at in the portfolios, you have to look at things that do well in inflationary environments. Obviously, the costs of raw materials and energy are moving higher. So a lot of our basic commodities, and for many years, commodities were ignored. We see that in food prices as well at the grocery store. It's been somewhat of an uneven tale of different costs. Healthcare has gone up considerably. Food costs, energy costs. So there's things that you can do to really take advantage of that in the portfolio for growth. But I think maybe just as important, if not more important, is what not to do. Back in the 70s, people were getting, high inflation, high interest rates. They were getting decent bond yields. They were going out, buying a safe bond, getting a coupon at a decent rate of return. Now, when
some cases, double-digit returns on a CD of 1 or 2 years.
Exactly.
Remember those mortgages that had, double-digit numbers and a big balloon that you had to figure out how you were going to refinance in a few years? We don't see that right now with the 10-year Treasury sitting at, 1.5% or so.
Exactly. It's not there. Mortgage rates are crazy low, comparatively, relatively speaking. And bond yields are, Joe, like you said, 1.5% on a 10-year Treasury. So you ask somebody, you want to lock up your money at 1.5% for 10 years when inflation's at 6% here?
That sounds to me like a surefire way. If the cost of things are going at 6 and I'm only getting 1, congratulations, you were really safely losing 5% on your portfolio over that 10 years.
Exactly.
So this is a real issue.
It is. It's very real. And I like that you're safely losing money there. Right? You don't have to worry about it. You're going to lose it year in, year out. You're losing your purchasing power. Another thing to mention, too, is that with higher inflation, we expect interest rates probably to move up in the next year. And when that happens, bond prices go down. So people sitting on a large bond portfolio maybe isn't as safe as they once thought that it would be.
Go back to 1981. If you're 65 today, that's, you were 25 years old back then. Average annual inflation rate in 1981, 14%. I mean, we're spending today's program talking about a 6-7% clip, but I mean, this could get far worse. And the monetary policy, the way that the government combats this is by rising interest rates. Well, if I'm sitting on what we've been told here since the mid-'80s to put our money, a 60-40 blend, put 60% into stocks, but make sure you have that component that's in fixed income, and you're buying the Vanguard, Fidelity, you name it, 1-800 mutual fund, total return bond fund. Well, in a rising interest rate environment, you go and look and have your advisor show you what that looks like. It does not fare well. It means that if we start to see rising interest rates, what so many families have relied on, what we've been told for decades now is the way to be managing our portfolios, it's maybe time to re-engineer that. What's worked over the last 20 years could maybe very well be something that is not going to fare well over the next 10.
Right. It's a very different environment. I mean, we're used to very low inflation. Some of these sectors are probably going to see a big rotation, and I think a lot of investors have become very complacent over the last 10 years or so. They expect the stock market to go up forever, and they really haven't paid much attention to that asset allocation and asset selection, and it's probably a good time to sit down and take a deep, hard look at that because it seems that things are going to change.
Let me ask you, if you look at your retirement savings today, the way it's invested, is it purely just around the investment tools, or can you say with confidence that you have a plan on how to take your money back, how to make it last a lifetime, how to make sure that you don't lose your buying power if we see this persistent, as now they're saying, inflation. Let's hope we don't go back to the 1970s where we saw double-digit inflationary numbers. But with all the stimulus out there, it's becoming more and more a potential reality. The real problem is that growing your retirement savings today, and I've been saying this for a long time, but I know that now it's even harder and more challenging than ever before. You may not realize it, but probably the fastest and safest way that you can help grow your nest egg, protect the nest egg, make sure you have a secured retirement, is by reducing taxes. Yeah, we're going to be paying more for groceries and gas, but let's make sure that we don't also get hit with higher taxes. After all, I mean, the less money that I have to pay the IRS, well, that's more money that you get to spend on everyday items to maintain your lifestyle in retirement. That's why we're making a special offer for today's listeners. I want our team to sit down with you and show you how you can reduce, sometimes even eliminate taxes altogether in retirement with the free secured retirement tax analysis. Let me explain how it works. We just gather some basic information from you, then we'll sit down, we'll bring it to the lab, and we'll crunch some numbers, and then we'll sit down and we can determine some tax-saving strategies that are best suited for your unique and tailored to your specific situation. We sit down, we share these with you, and you can see exactly how much money you could be saving with a proactive tax plan, what we call the Secured Retirement Tax Plan. So this isn't some obvious deductions that you're counting on your CPA or tax preparer to help you with. We're talking about tens of thousands, sometimes hundreds of thousands of dollars of lifetime savings in taxes just by using some simple defensive strategies. The opportunity to save money on taxes could very soon end, at least with the 40-year tax lows we're at. So get your secured retirement tax analysis today by calling 952-777-8838. They're going to change tax rates in Washington, and you don't want to miss out on some of these opportunities. So call this morning, 952-777-8838, 952-777-8838.
When we come back, how rising inflation could pose a major threat to your purchasing power and dramatically reduce your lifestyle in retirement.
That there is Nate Zeller. He's our investment strategist here at Secured Retirement Radio. I'm Joe Lucy, certified financial planner. More Secured Retirement Radio in a few minutes.
He's a certified financial planner, fiduciary, and a contributor to the Wall Street Journal. And he's no ordinary Joe. You're listening to Joe Lucy on Secured Retirement Radio.
Find us on your radio at AM 1130 and FM 103.5. Stream us on iHeartRadio. And now find us on OK Google, play Twin Cities News Talk on iHeartRadio.
Getting Twin Cities News Talk station from iHeartRadio.
Thanks, Google.
From the cremation system.
Have you noticed things are getting a little bit more pricey lately? It's not an illusion. For the first time in a long time, inflation is back in vogue. It's been reported that we could be on the verge of the worst bouts of inflation than we have seen in decades. In the bout to hit inflation, we are right now in it. The real question is, how long does it last and how bad does it get? Because if you're nearing retirement, the timing for this, it couldn't be worse. If you were in the golden decade between the ages of 60 and 70 within 5 years of retirement, this is coming at the worst time. Welcome back to Secured Retirement Radio. I'm Joe Lucy, certified financial planner. We got our investment strategist, Nate Zeller, here. We sent Dylan out of town for the Thanksgiving weekend here. Today we are talking about the inflation crisis that we are all experiencing here in America and how it can impact a secured retirement. Coming up in this segment, what should you be doing to prepare for rising inflation before it becomes a major threat to your lifestyle and retirement? Morning, Nate.
Good morning, Joe. So what we're looking at here is, the impacts that inflation has on retirees and their incomes. And I think that's the most important thing, is really the purchasing power and the income. As a retiree, you're past your earning years, so you're living off your savings, and what you want to create there is that income that keeps up with inflation. And, looking back over the last 20 years, inflation's been about 2% a year on average, give or take, from 2000 or so. Now we're looking at inflation at, say, 6%, which is the highest that it's been in 30 years. We have to go back to the 1990s. So what we want to do is make sure that the people that we work with, the people entering their retirement years or preparing for it, are well equipped to handle higher prices.
Well, here's what's interesting is we talk about that income you were just mentioning here, Nate, and we oftentimes refer to what I call mailbox income. It's money that hits the checkbook regardless of what's going on in your portfolios, right? It's things like the foundation of everybody's retirement, Social Security. Now, I go back to that 2000 through 2020 when inflation was running at 2%. According to the Senior Citizens League, Social Security beneficiaries lost 33% of their buying power in that 20-year span. Now, that's when inflation was 2%. Now let's throw it at 6%. At 6%, this could be, going back to the days of what a fixed income is in retirement, boy, this could be really, really something you need to be looking at, because if you are relying on Social Security, and most of you are going to be relying on Social Security to be at least an important part of your income plan in retirement, if that is going to be losing its buying power, we need to start looking at things we can do. We've all probably heard about, a frog in a pot of boiling water. If you got a pot of boiling water, the water's raging and it's in a full roll there, you throw a frog in it, the frog's going to jump out. He doesn't want to hang out too long in boiling water. However, if you take that pot and it's not boiling and you put the frog in it, and then you turn on the heat, and as it heats up, that frog is taking a bath. He's enjoying every bit of this until it's too late and now he's boiling. If you are not starting to address inflation, and we've been talking about this, Nate, quite a bit over the last, let's call it 8 weeks or so, probably since really July, when we started seeing some of these numbers coming through. If you've been listening to us and you haven't started to have that discussion with your trusted professionals about what are we doing in our portfolio today, how are you protecting my retirement income against this rising inflation? Well, it's kind of like you're a frog in that pot. You're just kind of enjoying the hot tub here until it gets too late. They announced Social Security increase for 2022 here of 5.9%. Biggest we've seen going back to, I think, 1990.
Oh, no, longer than that, early 80s. It's been 40 years.
So, that's 5.9%. Hey, sounds pretty good. I got my Social Security income. They gave me a nice little pay raise. The problem is this, that Medicare you're paying for, that's going up by 14%. In fact, many retirees on Social Security, their net number, the number they get to see in their checkbook, may not actually increase because of the offset of what we're paying towards our health insurance. Is this something that's important enough that you start planning for it? Because if the retirement planning you're doing right now is really just on the investment tools, hey, should I be buying Apple right now? Or what do I do with my, Google stock? It has to go past that. You got to start thinking about, how am I going to take my money back? How do I keep up with inflation, which is for real? And it's no longer just transitory. It's now persistent, as the government says. And what do I need to be doing in my planning to make sure I'm addressing that? Again, if it's just about whether or not you should be buying more international, or unfortunately, we're seeing families that are buying more bonds at a time that could be devastating, then you don't really have a plan to have a secured retirement. And that's what really we've been talking about here today. If this inflation is around, what do we need to be doing? And one of the best areas to do this, even though I said that your Social Security got a nice pay raise, but it's going to be offset by Medicare, but it's to focus on mailbox income and how do I make sure I have a certain amount of money in the checkbook each and every month, regardless of what my portfolio balance is doing.
And the thing that's important about this, too, is looking ahead. I think too often...
Have you noticed, I'm sure you already have, but we're paying more for groceries. We see it at the gas pumps. Haven't gotten those heating bills yet, but we know those are about to go through the roof. And boy, we're paying a little bit more for just about everything. And it's not your imagination. It's what they call inflation. Ronnie Reagan called it the silent killer for retirees. And if you are in or nearing retirement and you haven't started to address this in your planning, well, it could have a crippling and devastating impact on how far your money goes. So welcome back to Secure Retirement Radio. I'm Joe Lucy, CFP. I got Nate Zeller. He's our investment strategist. Today we're talking about the inflation crisis we're all experiencing here in America and what it means for you and your retirement. Coming up in this next segment here, or the final segment actually, most successful investment strategies that you can be doing. What are the things that you can be doing to keep up with inflation so you don't end up losing your buying power? Now, last segment I talked about the frog that gets thrown into the pot of boiling water. It jumps out. However, if I put the frog in the water, then start to heat it up, he thinks he's taking a hot tub, and next thing you know, it's devastating. Nobody wants to be a frog. Let's start talking here, Nate. What are some things? What are those inflation beaters that they want to be thinking about so that they are starting to be proactive about what these rising costs is and what it means for their making their money last as long as they need it to?
Certainly, and I think that's the key, is making the money last. And like we were talking a few moments ago, too, providing that sustained income that they need that maintains the purchasing power and keeps up with inflation. And really, when it comes to inflation, I think you have to look at it from two sides. It's offensive and defensive. And you want the defensive part of that there to hedge against inflation, the things that protect against it. And then you can also look on the offensive side and things that will profit from it. So you look at things that do well in an inflationary environment. Raw materials, we've talked about, just basic commodities. We've seen higher energy prices, for example. Those will probably continue to move upwards. Food prices have gone up dramatically. Real estate tends to do well in inflationary environments. Precious metals. I'm throwing out a lot of different things here. And one thing I want to caution against too is you see these commercials on TV or whatever for, fill your portfolio full of gold. It's the only true inflationary hedge. Well, it might be, but that's not a prudent investment strategy.
It can be devastating. And actually, a lot of folks have gotten broke just waiting for gold to go up in value.
Right. They could be waiting a long time. And we look at what gold's done over the last year, and it's been pretty flat, even a little bit negative, and it has not kept up with inflation. And it gets back to the old investment adage, don't put all of your eggs into one basket. So, well,
and we aren't saying to avoid gold either. In fact, we have some gold in some of our portfolios. It's just that we aren't overweighting gold. We aren't. We're trying to reduce some of those things that don't do well in a rising interest rate environment, like fixed income. Doesn't mean we've eliminated it. It just means that you want to be prudent about it, as you were saying, and start to really do an analysis, a deep dive into what your portfolio is going to do. We oftentimes use this tool that will allow us to run scenarios. What does it mean if we see an increase? So what if the 10-year Treasury goes from 1.5 to 2.5, where we were before COVID? Well, what does that mean for a portfolio right now? Somebody that had those bonds in that portfolio as the interest rates dropped, it actually helped them. But as the pendulum swings around here, that could be troublesome.
Yeah, we've been in a 40-year bull market on bonds, and that's most likely going to change and go the other direction. Like you said, the pendulum's going to swing the other direction and could for a long time. So the bonds aren't providing the safety, and they're certainly not good hedges against inflation. And as a matter of fact, it's probably the worst place to be. So it's time to look at alternatives to that.
Well, and I know that, for the last, let's call it 10 years anyways, it's been the larger companies. If you simply were investing in the S&P 500, or even more specifically, they talk about FANGs, the Facebooks, Amazon, Netflix, Googles. These stocks have really been driving things, but we go back and start to analyze what the portfolios that did well back in the 70s, high interest rates, and such, bringing that portfolio towards some smaller companies or mid-sized companies can be also an offensive way. And again, as you said, Nate, and watch the Vikings and you'll realize that this is important, right? We got offense and defense, and it's really about making sure you're looking at both and exploring all the different options to make sure that you have a portfolio. More importantly, an entire retirement plan, not just focusing on the portfolio, to make sure that you can spend in confidence throughout your retirement years.
And Joe, that's a very key point here too, is the investment portfolio is just one of the vehicles to get you there. But I think the ultimate goal isn't to have the biggest and best investment portfolio. It's to provide that income, as you get into retirement.
We've been talking this entire morning here about inflation and what the crisis means for you in your retirement that we're starting to see. Now, One of the reasons for the inflation we're seeing is because there's a whole lot of money out there chasing few good goods. Some of that has been self-inflicted. We continue to pass these stimulus packages that adds more money to something where we've already got enough of it, arguably. And all of this is going to come with a price tag. We're all going to have to start paying for the measures that have been taken to help get us through the pandemic. All this money that's been put in there to stimulus means, well, unfortunately for everybody, higher taxes down the road. You know, we talked about how inflation is a tax. It's a regressionary tax. It's a tax on everybody because everybody's paying more at the pump. But as we start to see Washington steer towards even higher tax rates, well, it's something we need to start thinking about because growing your retirement savings, it is more challenging today than it ever has been. You may not realize it, but the fastest and safest ways that you can help grow your nest egg right now, well, it's probably by focusing on taxes in your in your retirement planning. After all, the less money you have to give the IRS, well, that's more for you and your family to offset the inflation we've been talking about. That's why we're making a special offer just for today's listeners. I want to show you how you can reduce, sometimes even eliminate taxes altogether in your retirement plan. We're offering a secured retirement tax analysis. There's no cost. There's no obligation. Here's how it works. We just gather some basic information. We'll bring it back to the lab. We'll determine some tax saving strategies that are best suited for your specific. They're tailored to you and your specific retirement. And then we'll sit down with you and we'll share these strategies with you. You can see exactly how much money you can save. We're not talking about just saving a couple bucks on the tax return. We're talking about sometimes hundreds of thousands of dollars in lifetime tax savings. If you would like to get your free secured retirement tax analysis, give us a call right now, 952-777-8838. The opportunity for some of these are running out soon. So get your secured retirement.
Broadcasting on AM 1130, 103.5 FM, 100.3 HD2, and worldwide on iHeartRadio. This is the Twin Cities News Talk Station, KTLK AM, Minneapolis.
More countries are detecting cases of the new coronavirus variant. I'm Pam Puso, Fox News. Health officials in the UK say 2 COVID-19 infections linked to the Omicron variant have been identified. The case is connected to travelers from South Africa. The variant also found in Belgium, Hong Kong, and Israel, and possibly Germany and the Netherlands.
The U.S. has joined the UK and European Union in pausing travel to South Africa and 7 neighboring nations.